Advanced Financial Accounting OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to foreign currency remeasurement AICPA adopted. Get ready to account with Advanced Financial Accounting. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to follow along in OneNote, but if you would like to, we are in the 1239 area for the foreign currency remeasurement AICPA adopted. That's in the problem presentations tab. Closing this back up, we're going to go through all the information first within the practice problem. Then we'll take pieces of that information as we work through the practice problem. So we have the foreign currency remeasurement AICPA adopted on 11X0P formed a foreign subsidiary that issued all of its outstanding common stock to P. So P is going to be the parent company. S is going to be the subsidiary. S was formed by P on 11X0. So it's a fully owned subsidiary at that point in time. The issue is going to be that the subsidiary is going to be in a foreign country and conducting their books, therefore, in a foreign currency. And then when we do the consolidation, we're going to have to deal with how we're going to bring that foreign currency units over to the dollar so that we can combine them with the parent company, where the parent company is being accounted for in and using the US dollar. So here we have our information for 2000X1, 2000X2. The foreign currency is going to be labeled with the LAK, and the dollar sign will be used for dollars. So we got our applicable accounts. We're going to be focusing in on some applicable accounts, including accounts receivable, inventory, property, plants, and equipment, long-term debt, and so on and so forth. We'll come back to these as we start to work the practice problem. Then we have the exchange rates and the relevant dates. Notice that we do have date ranges. So we're looking at a certain date range and we're comparing, and also note the comparison. We're comparing the foreign currency compared to $1 US. $1 US, and then the foreign currency. So we've got the relevant dates as well as the average dates for 2000X0 and 2000X1 that we will be going back to. We have more information for the accounts receivable. Now note, as we go through this more information, one of our questions is going to be, scrolling back up, if we look at these accounts up top, accounts receivable, inventories, property, plant, and equipment, so on and so forth. Our question is, notice there's two kind of ways that we will think about converting this to $2, and we'll talk more about those ways in a second, but it's going to be translation and remeasurement. Then the next step is to think about, okay, now that we know, the process that we're going to be using, then what rates should we be using here, and do we need to know more information? Now, typically, if we're looking at balance sheet accounts, the two options, I would call the default option for the rate that we're going to be using will be the balance sheet date, the current date as of the balance sheet date, which means the year-end date at 12/31. So, and that makes sense for the most part, right? Because if you think about the financial statements that are created, all financial statements for the year ended December 31st, the balance sheet is as of December 31st. So our first thought, or my first thought when you think about it, well, what rate would we use? Well, December 31st, because that's like when the balance sheet end date would be. But then we might use a historical date for some large type of purchases, such as property, plant, equipment, and inventory. So then really the question is, if we're going to then use a historical date, something other than 12/31 for the balance sheet accounts, then do we need more information? What more information do we need? So then we're going to give some more information about some of these balance sheet accounts to see if they're going to be applicable, to see if we're going to use some other something else other than just simply the year end or period end date to record the exchange rates. Okay, so then we have the more information for the accounts receivable accounts, then more information for the allowance for doubtful accounts. We've got the first in, first out inventory method that we'll be using, and then the cost of goods sold calculation to give us the detail on the inventory as well as the cost of goods sold, beginning inventory plus purchases, costs or goods available for sale, and then subtracting out the ending inventory. That's going to give us our cost of goods sold. We have more information related to the property, plants, and equipment. That includes land that was purchased on 11X0, equipment that was purchased on 11X0. This was by the subsidiary. And then on 74X1, the purchase of equipment. The depreciable life that we're going to be dealing with is 10 years. The full year depreciation is taken in the year of purchase. So in other words, this second item was purchased on 74X1. We're going to be taking the full year of depreciation for that item as well. Then we have on 115X0, this is when the bonds were issued. So we'll have bonds on the books. They had a face amount of 150,000 foreign currency units, 7% interest, maturity on 115x6, interest paid on July 15th and January 15th, so semi-annual interest payments. First payment made July 15th, 2000x0. Then we're going to make a schedule of remeasuring selected accounts into US dollars. US dollar is the functional currency of S. So quick word on the remeasuring process. Notice that if we're looking at the accounts of the subsidiary, this is the story here. The subsidiary was created. It's in a foreign country. It's conducting their books in a foreign currency. The typical question then is, how are we going to basically convert that foreign currency unit into dollars so we can have a consolidated financial statements with the parent company, which is in US dollars? Well, the two main ways that we would do that is we would say, well, what's the functional currency? And then the two functional currencies usually would be either the foreign currency that the books are in which case we would be using the translation process, or we're going to say that the functional currency is actually the US dollar, in which case we're going to be using the remeasurement. So if the foreign currency again is the units, the foreign currency units that typically the books are going to be in, if they're in the foreign currency possibly, then I mean if the books are in a foreign country and they're being measured in US dollars, we don't really have a problem there because that the parent company's in US dollars. So typically the scenario that has a problem is the foreign company is in some currency other than the US dollar, and then the question is how do we convert that? If the functional currency, and you can look at the definition of the functional currency in prior presentations about the functional currency, but if the functional currency is the foreign currency, then we're going to use a translation. If the functional currency is actually the US dollar, then we're going to use a remeasurement process. It's also possible to have a third scenario where the foreign company is conducting their books in something other than the functional currency, and the functional currency is not the US dollar, the same currency as the parent company, but that's going to be a little bit more unusual of a situation. Typically, the foreign company would be conducting their books in the currency at the location that they're in, possibly. That's when there would be an issue. And then the question would be, is that the functional currency, or is the dollar, the parent company's currency, the functional currency? Okay, so now that we have that information, we're gonna go through our account, and we're gonna be doing then, of course, the remeasurement process here. So we're using remeasurement and not translation. So we're going to go through these accounts, and we're going to be looking at the applicable rates that we're going to be using and seeing if we need any more information in order to apply those rates. We're going to start accounts receivable. So we're going to be picking up the accounts receivable balance. So we're going to go down to our data down here. We can see at the end of the time period for 2000X1, the receivable was 35,000 foreign currency units. Then the question is, what rate should we use for that 35,000 to convert it? And the dates are really what we're looking at this point. Now, for the accounts receivable, we would use what I would call like the default, typically both for the translation and remeasurement process. Notice we're on the remeasurement process here, which is a little bit more difficult typically, because there's going to be more, jumping back and forth when we're thinking about the assets and liabilities between using basically the current date as of the end of the balance sheet date 12/31 usually, and the date, some kind of date other than that, which usually would be some kind of historical date when the transaction took place. Now, the accounts receivable, because it's basically going to be received in cash, we're usually going to use the end date, kind of like the default date, which would be the current date, the 12/31 date if we're talking about financial statements made as of 12/31. And so we're going to be picking up that 1.7, so 1.7, which can be found on our table down here, on the 11/1x0 to 6/30x0. That includes 12/31 in it. So we're going to be picking up that 1.7. Now we also note that we're going to be dividing this out. So notice the way these are accounted for down here. We have the foreign currency units is to $1. So 1.7 foreign currency units is to $1. Therefore, we're going to be using division down here to account for this. So we're going to say, all right, this is the 35,000 divided by the 20,005, divided by the 1.7 is going to give us that 20,588. Notice there is rounding, so rounding is a factor. Be aware there could be slight differences due to the rounding. Now, we are using the remeasurement process, and that's when we have more questions about this, but this would be the same for the translation. For the translation, we would typically be using the balance sheet account, the current date as of the end of the balance sheet date for most of these items, as we'll see in a future problem. So then we're taking a look at the inventory. So inventory we're going to put on the books here. That's going to be the 67,000. So it's on the books at the 67,000. Then we need to convert it. Then again, we need to think about the rate. This one's going to differ typically because now we might want a historical rate. We're not talking about currency units. We're not going to get paid in dollars or be spending or using the inventory, selling the inventory. We're thinking about, so we have more of a historical possibly system that we would want to use. So then the question would be, okay, well, when did we buy the inventory? This would typically differ from remeasurement process, which we are using here, and the translation process where we would probably continue to use the 1.7 end of the period date. So then we're going to scroll down and we're going to go, all right, now let's look down here at the inventory information, which is here. So we have first in, first out, so what's going to be used. So the first in, first out flow method is going to be used, and that means that the ending inventory then is going to be consisting of the later units that were purchased. So in 2000X0, we had 380,000 purchased. Nothing was in beginning inventory because it's the first year of operations, and then ending inventory is that 67,000. We purchased all of that on 6X0. So we're looking for the date for 6X0. So then we're going to go over here to the dates. So 6X0 is going to be here between 11X0 and 71X0. So we're going to be using that 2 for the exchange rate. So I'm going to go back up. So we're going to be using the 2 here, and we'll just do our calculation then once again, which is going to be the 67,000 divided by 2 is the 33.5. All right, then we have the property, plant, and the equipment. Property, plant, and the equipment is going to be here. We're picking up that 173,000 on the property, plant, and equipment. Once again, we're going to deviate from the normal standard default 1231 rule because we're not getting, this isn't a cash type of thing. We got property, plants, and equipment. We want to take the historical time again. So we're going to have to think about when the property, plant, and equipment was purchased. So if we go down, we're going to say, all right, let's see if they give us some information on that. We'd have to, in real life, of course, we would have to drill down to the general ledger, look at the date of when the stuff was purchased. Here they gave us these transactions. We got land and PP&E, property, plants, and equipment on 11X0. So we're looking for the date on 11X0 then. So that's going to be over here. And that's going to also be on this range, the 2, which is 11X0 to 71X0. So we're using that 2 again. So the 2, and then we'll do our calculation, which is simply going to be the 173,000 divided by 2 is the 86.5. The 86.5. All right. Next item, we have the long-term debt. So we're picking up the long-term debt now. It's going to be that 150. It's something that's going to be typically paid in cash again. So usually we would use the ending of the period, the default kind of rate as of 12/31, the ending date of the balance sheet that we're representing this as. And so if we go down, we're going to say that's going to be like the 12/31 date. So here we have on 11/1 to 6/30, and that's going to include the 1.7. So 12/31's in there. We got the 1.7 just like we had up here for the receivable. And then if I do the calculation again, you probably don't need me to do the calculation, but 150,000 divided by the 1.7 going to give us that 88,235. 88,235. Next item is going to be the common stock. So we'll pick up the common stock down here. Now we're in like the equity section, of course. We got the 65,000, 65,000. What's the rate we're going to use there? Common stock's going to be a little bit different. Assets and liabilities are, notice, assets and liabilities, we are using remeasurement, which all the way down, these would typically, if we were having a translation process, would be using the 1.7 all the way down. Here, because we're using remeasurement, we've got these changes. We're doing historical costs for the inventories and the property, plant, and equipment. And then the common stock, we would differ on whether we're using remeasurement or the translation. And that's going to be the date. We're going to think about the date of when the common stock changed. And of course, that was when the purchase took place. The parent purchased all the common stock. So we're going to go back basically to the point in time that the purchase happened. That was at the beginning of 2000 and X0 in this case. Nothing else happened during the year because obviously the parent purchased all of the outstanding common stock of the subsidiary at the beginning of the year, and then nothing else happened since that point in time. So we're going to go back to that point in time. That's going to be on, it's going to be including this 11x0. So we're going to be using that 2 again. So we'll take the 2 again. We'll take the 2 again. And 65,000 divided by that 2, 32,500. So 32,500. Then let's go to 2000 X or X1. So we'll do the same thing for X1 now. So now we have the second year of operations. The purchase happened in 2000. Parent purchased the outstanding stock of the subsidiary in 2000. And now we're talking about the year end 2000 X1, which is the second year after that has happened. And we haven't really looked at a problem like this in the past because we've generally been considering the year in which the purchase took place. So some differences here in what we've seen in the past. Okay, accounts receivable, same process, but now we're just going to take the 40,000 that's at the end of the year. So 40,000, and once again, because it's the kind of like we're getting cash, it's basically a cash thing that we're going to be receiving. We're not using historical rates here. We're typically using what I would call like the default, the date as of the end of the period, now being 12/31/X1. So we're looking for the rate at the end there, which is going to be this 1.5, because that includes the 7/1/X1 to 12/31/X1. So we've got the 1.5. We do the calculation again. Calculator, 40,000 divided by 1.5 gives us that 26,667 rounded. Okay, and then bringing this on down, we got the inventories. So if we're going to pull over the inventories, 72,000, so 72,000 here. And then we're going to use, this time we're going to deviate. This is what we're doing with remeasurement. If it was translation, we would probably be using the same date. But now we're going to be using a historical date for the remeasurement process. So we're going to need to look then when the inventory was purchased. So if we go down, we're going to say, all right, inventory, first in, first out. So last year we had this items happening, and then we had the beginning balance left over from last year, but those are going to be like the first units that were sold, and then there was more purchases of 340,000, and then the sales were here, and now we have the ending inventory, the 72,000, which we're assuming all consist of the latest units that were purchased because we're using the first in, first out method. So that's going to be the purchase happened on 6/2000/X1. So we're looking for the date 6/2000/X1. So let's go over here, 6/2000/X1. So here it is from 11/1/X0 to 6/30/X1, which is including our date there. So we got the 1.7. That's what we want up here, the 1.7. So we're going to pick that up. Let's do our calculator, trusty calculator, 72,000 divided by 1.7. That's going to be the 42,353. 42,353. Next item, property, plant, and equipment. So we're going to be picking up the PP&E, property, plant, and equipment, that 187.5, the 187.5. Now this one, we would be using, once again, the historical date again, as we did in the prior year, deviating from what we would do from the translation, which again would be used basically the end of the period date on the balance sheet. We would be using the 1.5 remeasurement historical date. Now, if we go down there, we're going to think, okay, what's the property, plant, and equipment consisting of at this point in time? And we're going to go, let's see, we had land was purchased this year of the 35,000, but then we had those purchases that happened last year. And so now we've got, if we use the historical cost of when they were purchased, now we've got 2 years back, which is going to get a little bit more confusing. We can't really just use one rate now. We got to use a worksheet to kind of figure out, when this stuff was purchased, and then take into account the depreciation related to it and whatnot. Now, note again, if you had the parent company purchasing the subsidiary and they already had the equipment on the books, they had purchased it before the parent company purchased the subsidiary, instead of, in this case, the parent company making the subsidiary, then you would be thinking, well, what do I use? Do I use the historic date, which happened before the purchase took place, or do I use the purchase date when the parent company purchased the common stock of the subsidiary? There, as we've seen in the past, you typically use the purchase date when the parent company purchased the subsidiary. So at that point, it's all kind of using that same beginning balance date. But then as time goes by, if there was more equipment that was purchased at a later time, then you're going to start to consider different rates that will happen based on when they were purchased. So in this case, now we have 2 years of information that we're going to have to be dealing with, and so we're going to need a more complex schedule to do that. So we're going to go back to that one. We're not going to do it yet, but we'll go back to it later. So then we have the long-term debt. Long-term debt down here, it's on the books at the $130,000. Now this one, after looking at that complex one, this one's a little easier because it's basically we're going to get paid in cash again. So we're going to use the ending, or we're going to pay in cash. Sorry, it's going to be a cash type of thing though. So we're not going to use like the historic date here. We're going to use the date as of the end of the balance sheet date, the 12/31 date, which is once again that 1.5. That 1.5 coming from here. So 71x1 to 1231x1, there's the 1.5, there's the 1.5. If we do the division here, we're going to be taking then the 130,000 over divided by 1.5. That's going to give us the 86,667 about rounded. Okay, and then we will take, let's move this down because I might need it later. I don't want to delete it. I just want to move it somewhere. Okay, the common stock. Same scenario on the common stock. It's going to differ now because we're going to use kind of like the historical item. Now, we're going to be picking up the common stock. It's still 65,000. It hasn't changed since the purchase took place, which was like 2 years ago. So, S company created, they didn't purchase, they made the subsidiary, the foreign subsidiary in 2000X0. And then the common stock obviously didn't change for the 2-year time period now. So then the question is on the common stock, because it's the retained earnings items, you're thinking, okay, should I go back to the beginning of the year, or do I go all the way back to, the last time the common stock changed, basically the purchase typically, or in this case, the creation of the subsidiary. And we're going to go back to basically the creation of the subsidiary because that's kind of like the historical cost, which now is like 2 years ago from today. So we're using that same exchange rate. And obviously in practice, this would be a little bit easier because at least you'd have the working papers of it's not like you'd be looking up the rates every time. You'd know what the rates are if you're using the same rate that you had last time. But in any case, we're going to be picking up then the 2. That's going to be up top on the 11x0. So there it is. It's included there, that 2. And that's going to be this one. So once again, we're going to be taking the 65,000 divided by 2. And there's the 32.5. Notice again, this would be similar from this actual component will be similar if we were using translation as opposed to what we're using here, which is remeasurement. We would be doing a similar process here on the equity section for that account, as we'll see in a future problem. Okay, so now we obviously need to do something because we got this 99. It's like, how did that get there? Like, we don't have a rate. Well, we'll go down here and we're gonna figure that out. So that'll be the worksheet we have now. I'm gonna bring this hider thing down here so we can have the whole mystery reveal happen as we go to increase the level of excitement. So there we have that. Okay. So now we're going to have the land was purchased. So we're going to go through our land purchases now. So we got the purchase of land that happened, and then we're going to go through land purchases and property, plants, and equipment. So then we had the 2 property, plants, and equipment. We're going to start off with the land. Now land is easy because we don't have any depreciation related to it, which is nice. So we're going to say the land was purchased on 11x0 for 20,000, and the rate at that point in time, as we can see up here, is 2. So that's going to give us our 10,000. We'll divide that out. I won't pull up the trusty calculator to do that because we've seen it a few times. Same process. Then we're going to go to the property, plant, and equipment, or plant and equipment. We had this purchase up top that happened on 11x0 for 170,000. So we're going to put that on the books for the 170,000. We're going to use the same conversion because once again it happened on 11x0. So 2. We're going to divide that out. 170 divided by 2 is going to be 85,000. Then we're going to take a look at the depreciation related to it. And as we do that, just note up top when we're considering these amounts on the property, plant, and equipment, they are recorded net of the accumulated depreciation, which is down here. So when we're thinking about our conversion rates up here for example, year 1, we had the property, plants, and equipment net of the depreciation, accumulated depreciation, and then we just had to multiply that times the 1 rate. So you can think about those broken out in 2 accounts too, if you so choose. Here, we're going to have to apply the rate for the original cost and the depreciation. So the depreciation is going to be the 170,000 divided by the useful life, which we said was 10 years. So 170,000 divided by 10 years gives us the 17,000. 17,000, then we're going to take the same rate 2. We're going to take that 17,000 divided by 2. That gives us the 8,500. We're going to be reducing the original cost by this amount, of course, because it's the depreciation. Then depreciation for year 2, same thing, because it's a straight line depreciation. We have the 17,000 depreciation, accumulated depreciation. And then we have the 2, and we're going to take the 17,000 divided by 2 to give us that 8,500. Therefore, the book value at the end of the second, for this item, for this property, plant, and equipment, is the 85,000 minus the 8,500 minus the 8,500. So as of the end of 2000X1, book value then 68,000. All right, then we had one more piece of equipment down here that was purchased on X1, in X1. Original cost was 35,000. This was given to us in the data up top. So we have the 35,000. So then we're going to pick up the relevant date. Now we're going to be picking up the 1.5 because it was purchased on 7/1. So 7/1X0, if we look at our dates, 7/1X0 is included in here. So that's where we're going to pick up our rate, which is now different, of course, at the 1.5, which is the thing that's kind of throwing us off here. This is the reason we needed the table in the first place. And then if we take the 35,000 divided by the 1.5, we get the 23,333. Then we want the depreciation. So we're going to take that 35,000 divided by the useful life, that being 10. So 35,000 divided by 10 is the 3,500. Then we're going to take that amount divided by the 1.5 rate to give us 2,333. And if we subtract those two out, then we've got the 23,000 minus the 2,333 gives us the 21,000. Also note, because we're using the same rates down here, and this is why we could use, the one rate applied to the net book value for year 1. We could take, obviously, the property, plants, and equipment minus the accumulated depreciation, the book value, multiplied times or divided by that rate, 31,500, and we get to the same 1.5, the same 21,000. As we would if we take each component, multiply times the same rate, get 23,333 minus 2,333, we get the 21,000. So either way will work, as long as, again, if you're using the same rates given the properties of multiplication. Okay, so then we're going to be adding these up. We're going to say, all right, then we've got the 10,000 for the land. It doesn't go down in value. We got the 68,000 plus the 68,000 for the equipment that was purchased in last year, X0, and then plus the 99,000 for the equipment purchased in the current year. And note that this equipment down here should be in dollars rather than the foreign currency units. So I've made that adjustment now. This is in dollars over here. That's the point. So then we got the $99,000, and that's how we get this 99 up here that we've already put into our table up top for the PP&E, property, plant, and equipment. We'll do a later problem on this in a similar process, which will be easier for the translation process, so you can compare and contrast when we would use basically the same rates as of the end of the balance sheet dates for the assets and liabilities, and then what are we going to do with the equity section, and when would we deviate between the two methods, or deviate from that default rate is what I would kind of think of, and use basically kind of like a historical rate when using the two methods, remeasurement versus the translation method.